$6 billion in fines just exposed the regulatory liability hiding inside your tech holdings. If you hold Alphabet directly, or own a target date fund, or hold any broad index fund, you own a piece of Google's search monopoly. And the SEC just proved that monopoly isn't a competitive moat, it's a regulatory target. Here's why this matters right now. Most high-income professionals in the $200K, $500K household band hold 8–12% of their portfolio in mega-cap tech. On a $2M portfolio, that's roughly $160K, $240K in Alphabet at current multiples. If Google's search margin compresses by just 300 basis points, and the DOJ trial suggests it could, your unrealized position faces $75K, $150K in downside. Most portfolios don't account for that tail risk because consensus estimates still assume 30% plus search margins are durable. And here's the part that keeps institutional investors up at night. The market reprices this once, not gradually. By the end of this video, you'll know the exact 3 SEC filings that expose the fragility, the dollar math on margin compression, the timing of the 2025 DOJ verdict, and the stress test model you can run on your own holdings to know whether you're protected or exposed. Let's start with what the $6B fine actually reveals. On November 5, 2024, Google settled with the FTC over search result manipulation. The allegation: Google used its search dominance to extract monopoly rent not through better search technology but through forced bundling, exclusionary deals, and switching cost lock-in. That's regulatory speak for you're making 40–60% of your margin from control. Not innovation. Think about that ratio. If Alphabet's search segment generates $175.4 billion in annual revenue with a 32% operating margin, that's roughly $56 billion in operating income, and 40–60% of that comes from monopoly control rather than product superiority. You're looking at $22–34 billion in annually recurring margin that exists only because competitors can't access distribution. Open Alphabet's 10K filing for fiscal 2024. Search revenue is $175.4 billion. Operating margin on that segment, 32%. That's roughly $56 billion in annual operating income from search alone. Now cross-reference the SEC antitrust complaint filed in 2023. The document details Google's exclusionary agreements with Apple, $20 billion annually to be the default search engine, Samsung, Mozilla, and telecom carriers. Remove those agreements and you're looking at margin compression of 400–800 basis points just from the loss of lock-in revenue. Wall Street's current consensus, still pricing in 30% margins through 2026. That's the gap. That's where your portfolio risk lies. But here's where it gets worse, and this is the detail that separates informed investors from everyone else. The DOJ trial on forced divestitures starts in 2025, with a verdict expected mid-2026. The government's case centers on 15 U.S.C. Section 2, monopolization. If the court agrees, Google could be forced to divest Android or Chrome. Either scenario vaporizes the switching cost lock-in that sustains search margin. Android controls 70% of global smartphone operating systems. Chrome controls 63% of browser share. These aren't side businesses, they're the distribution moat that keeps search margin elevated. Remove them and search becomes a utility, not a monopoly. Wall Street consensus. Still pricing Alphabet at 23–28x forward earnings with 30% search margin assumptions. That's a 200–300 basis point gap between current pricing and downside risk, and it's widening every quarter closer to trial. Now the portfolio impact I promised at the start. A $2M portfolio with 10% Alphabet concentration, that's $200K at current levels, at 24x P/E with earnings per share of $7.50 equals roughly a $180 stock price. If search margin compresses 300 basis points from 30% to 27%, and the multiple contracts from 24x to 20x as regulatory uncertainty compounds, that's roughly $155K in unrealized losses on your position. But here's the bear case. If the DOJ verdict goes plaintiff favorable and forces divestitures, search margin could fall to 24% and multiples could contract to 18x. That scenario prices your $200K position down to roughly $120K. That's a $80K swing. On a $2M portfolio, that's 4% of your net worth disappearing in a single quarter. The open loop I teased earlier, the 3 filings. 1. The 10K search margin and revenue segment breakdown updated annually. 2. The SEC antitrust complaint filed in 2023 details the $20B Apple deal and exclusionary practices with itemized dollar amounts. 3. The DOJ appeal brief filed September 2024, laying out the forced divestiture argument with legal precedent. All 3 are free on Sec.gov. All 3 tell a story that contradicts consensus earnings stability. Read them in this order: complaint first to understand the allegations, then the 10K to see the financial exposure, then the DOJ brief to understand trial timing and precedent. Here's your action: run a 3-scenario stress test on your tech allocation. Base case, Alphabet holds 24x and margins stay 30%. Bull case, Google wins the DOJ trial in 2026, multiple re-rates to 26x. Bear case, Google loses, divestitures occur, margins compressed to 24%, multiple contracts to 18x. That bear case is a $120K, $180K hit on a concentrated position. If that feels material to your long-term capital plan, it's time to trim or hedge. If it doesn't, you've at least priced the tail risk. The quiet observer wins by knowing what the market hasn't priced yet. The $2.6b fine wasn't a one-time cost. It was the opening bell on a structural revaluation of tech monopoly economics.